Nat gas futures are having a bit of a mixed day today after a big drop yesterday. Traders are keeping a close eye on the weather forecast and how it might affect demand, especially since the U.S. Energy Information Administration's weekly storage report was delayed by a day due to the holiday earlier this week. The weather models are showing that national nat gas demand will be high in the next few days, but will likely decrease over the weekend as weather systems move across the Midwest and East. We're expecting a hot weather pattern from July 12 to 20, with temperatures in the upper 80s to 100s across much of the U.S., which could mean very high demand. However, there are some cooler risks to consider. In the past week, natural gas prices have been going up and down around $2.70, but this morning the bears had the upper hand and pushed prices down from $2.79 to $2.60. Despite forecasts for hotter than normal weather and increased gas consumption by power plants, especially in Texas, U.S. natural gas futures displayed a mixed performance yesterday. In summary, natural gas futures are going through a bit of a mixed trading day as traders keep an eye on the weather forecast and the upcoming storage report. They're paying close attention to demand projections as the weather patterns change across the country. The market is sensitive to supply and demand dynamics, so any price fluctuations in the short term are likely to be influenced by these factors. An average gas output in the lower 48 states rose to 101.9 billion cubic feet per day so far in July, up from 100.9 billion in June, putting production on track to match the monthly record of 101.9 billion in May. With hotter weather coming, analysts forecast U.S. gas demand, including exports, would rise from 103 billion cubic feet per day this week to 103.3 billion next week. Meanwhile, the count of gas rigs continues to decline, with an additional 6 rigs dropping last week. Alexei Miller, the chairman of the board of directors of Gazprom, stated that the company does not view the arbitration of Naftogaz Ukraine as legitimate. Miller further mentioned that if Naftogaz continues with such actions, it is not unlikely for Russia to impose sanctions. Additionally, if Russia stops the transit of gas through Ukraine, Europe stands to lose 42 million cubic meters of natural gas supply. Furthermore, the Europeans took the brilliant step of closing down the Groningen gas fields, making the situation even worse for themselves. From a daily technical viewpoint, gas is trading on the weak side of its daily pivot at $2.70, but above the nearest support at $2.55. The long-term technicals are slightly bullish, but the short-term outlook indicates a developing downside trend. The current 50-day moving average provides strong support, indicating a high probability of natural gas rebounding from this level. A sustained move over the pivot at $2.70 will indicate the buying is getting stronger. This could lead to a near-term acceleration to the upside at $2.80, the nearest target. However, a sustained move under the $2.55 level will indicate the short-term selling pressure is getting stronger, with a retest of $2.40 as the next likely target.